Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Acca tutor, Mr. James Timklu, and in this video, I'm going to take you through the concept of relevant costing. This is a rich examination ground for the Acca performance management paper, and you need to get into that examination hall with this concept at the core of um, your heart. Okay, because if you are not prepared enough to meet relevant costing questions, then you are highly likely to fail the examination. Remember, relevant costing is a fundamental topic that link many of um, the computations in financial management, in performance management, and so forth. So it is actually a modern topic which a modern or a 21st century accountant should be able to master. Okay, now we discussed in the previous video on make or buy decisions that relevant costing is also part of the wider concept of limiting factor analysis. Both relevant costing and make or buy decisions are also part of short-term decision making, which means uh, financial managers need also to prepare for situations where companies should be able to sustain their cash flows in the short to medium term. We are not always going to be focused on the strategic perspective, but we also have to consider our livelihoods for today and tomorrow. Okay, so it doesn't mean that we should always be focused on the longer term horizon. Okay, now what is relevant costing? A relevant cost is a future cash flow arising as a direct consequence of a decision. So, which means for us to understand relevant costing, we need to understand what a relevant cost is. So we have actually read that this is a future cash flow, which means it's not only a cost, but a future cash flow. This actually gives a demarcation, or let me just say a distinction between the ordinary variable costs and a relevant cost. So variable costs, although they are applicable costs for managerial decisions, they do not, always impact cash flows. Okay? But when we talk now of relevant costing, we are now concerned about the actual money, the actual cash flow. All right? So please take note of that. Also take note that these are futuristic costs. Okay? They are costs that are going to happen in the future. All right, so it must be a cost that will occur in the future. Any cost that has already been incurred in the past cannot be a relevant cost. And remember, we've got two types of past costs. We have got sunk costs and committed costs. Now, what is the difference between sunk costs and committed costs? Okay, both of these costs are costs which have been which are considered past costs. However, sunk costs are paid costs. Okay, so the sunk ones are paid, but the committed ones are to be paid in future. Paid in future. So how can these committed costs become relevant if we are saying that we only have, if they are to be incurred in the future? The idea here is that committed costs, although they are going to be paid in the near future, the payment is so fixed legally that management have no control, have no alternative to avoid them. For example, if a company enters into a lease agreement, okay, where the terms and conditions are such that it is very impossible to avoid the payment of lease rentals, then we are going to say that those payments are now to be considered um, committed payments. Okay, so a contract has been entered in the past, right? That's the event that gave rise to the cost. All right, although we are going to pay this cost in the future, the fact that we cannot avoid that payment, then they become committed costs and past costs. So for managerial decision purposes, they are no longer relevant. It must be a cost or benefit that results in cash flow. Please, if there is no cash flow to take place, then the costs are not going to be relevant. For example, depreciation charges. Depreciation charges often are going to be incurred in the future, but they are not relevant because they don't give rise to a cash flow. Also, overhead absorption costs, they can also, they cannot be relevant as well. Okay, and you also remember that when we did absorption costing, the depreciation charges, overhead absorption costs, all those were considered fixed costs. All right, and by default, fixed costs are not going to be considered relevant costs. Why? Because managers do not have control over them. They are going to be incurred however expeditious, however talented the manager can be. All right, it must arise as a direct consequence of the decision. Any costs or benefits that will happen anyway, regardless of the decision, cannot be a relevant cost. So if this particular excuse me, if a cost is going to be incurred, uh, whether managers make decisions or not, then such type of costs are not going to be relevant. So when you be reading the scenario in the examination, please give careful attention to these principles. You also have to think of relevant cost, relevant costs as differential costs. They are differential in the sense that they are costs that give you a sense of comparison between possible alternatives. For example, cost of a new machine becomes a differential cost if you are deciding whether to make or buy it. So you can see that relevant costing and make or buy decisions are topics which are married to one another. Opportunity costs. Relevant costing takes into account opportunity costs, which are benefits foregone by choosing one alternative course of action over the other. So, if you are being confronted with two alternatives and you are then forced to pursue one of the alternatives, the amount of revenue you have lost in foregoing the other alternative is what is called an opportunity cost. You have missed that particular opportunity, so it is a cost to you. So in the examination, in the scenario, you will be told of a particular opportunity that is going to be missed, and the value of that opportunity is going to be considered a relevant cost. It is a relevant cost. So what is the decision criteria? Relevant costing uses the contribution margin, okay? And contribution margin, remember, is a marginal costing concept, okay? Where we are saying that contribution or contribution margin is equal to sales minus variable costs. So if you still also remember in the previous video on make or buy decisions, we say that for us to determine whether to buy outside or to make in-house, we need to compare the variable cost of production and the purchase price of the item from the outside supplier and see if the variable cost of production are higher than the purchase price. And if the variable cost of production are higher, then it means that we need then to think of buying outside. However, we then computed further to determine the excess cost of buying outside per unit of limiting factors. Please just revisit that video for you to to ace that particular aspect. Okay, so you can see that variable costing, which is the pinnacle of marginal costing, is actually here to stay. It's also part of this relevant costing principle. So we are saying we use the contribution margin or the net present value approach to arrive at the best decision. Now, the contribution margin is usually for short-term transactions. But when we are now looking at longer-term transactions or arrangements or business setups or arrangements or investments for the longer term, then we need to think of the discounted cash flow techniques, and this is when the net present value aspect comes into play. Okay, and we know that the net present value is actually the difference between the present value of future cash inflows and the present value of future cash outflows. And we then get what is called the net present value, which is the difference of the two. In pricing decisions, a relevant cost is a price at which the organization will be no better off, but no worse off if it sells the item at that price. Okay, so you can see that there is consideration for competition in relevant costing. We must not make superficial profits. That's not our idea. But at the same time, we must not be disadvantaged. So managers are being put to task to come up with reasonable prices that enable the business not to lose their customers, but at the same time to maintain a good net profit figure. Any price in excess of this, a minimum price will add to net profit. So whatever additional price above the minimum, remember, the concept of relevant costing is to enable us to determine the minimum price that is going to enable us to remain afloat. Okay, we are able to grow our business, but in a healthy way or in a competitive way. To sum up, excuse me, a relevant cost is the incremental cost. This is a very important formula. A relevant cost is the incremental cost plus the opportunity cost of making and selling the product or providing the service. And what are incremental costs? Incremental costs are costs arising as a result, as a direct result of a decision. Okay, so which means we are being taken to the point that if the decision does not require, if the cost does not require the input of managers to okay or not to okay, then it means that particular cost is not relevant. Okay, ladies and gentlemen, let us now do a typical past exam question. Okay. A company needs 400 kilograms of material Z to fulfill a customer order in 1 month's time. So what is needed? 400 kgs. Of what? Of material Z. When? 1 month's time. It currently has no material Z in inventory. The current purchase price of material Z is $20 per kg, and this is expected to rise to $24 per kg in 1 month's time. So in 1 month, it will rise from 20 to 24 kgs. I mean to $24 per kg. Material Z is perishable, and normally 20% of stored material is lost per month. Okay. Now you have read the first paragraph. Go to the question, because in the examination hall there is no opportunity for you to read the question like a storybook. There is no that opportunity. You then have to be organized. Okay, when you read the first paragraph, you go straight to the question requirement. What is the total relevant cost of material Z to fulfill the customer order? All right. So remember, you are now standing on the principles. We have read that we need to use relevant costing to ensure that we are not going to suffer to sustain losses, but at the same time, we are going to remain competitive. We are not going to lose. We don't want to lose a customer. So relevant costing will enable us to ensure that the customer is going to be happy, and us are also going to be happy. So we need to then determine from the scenario the possible scenarios. Okay, what are the scenarios? What are the possible options available? So let's then read the last paragraph. The company expects to have 200 kilograms of material Y in inventory in 1 month's time, with no alternative use other than to sell it for scrap for $18 per kg. The 200 kilograms of material Y, this same 200, okay, could be converted into 200 kilograms of Z in 1 month's time at a cost of $4 per kg. Okay, so material Y is not perishable. Okay, so we are expecting to have material Y in 1 month's time. Okay, and this material, let's talk of material Y. Okay, we're going to have this material, the 200 kgs, we're going to have them, all right? But they're not going to be useful to us. However, if we dispose of them, we are likely to get $18 per kg. Okay? If we dispose of the material, we are going to get $18 per kg. However, if we do not dispose of the material, okay, if we do not dispose of the material, then we are going to have an opportunity cost. If we do not dispose of the material, we are going to lose $18. $18 per kg, which is an opportunity cost. Okay, so we're going to lose $18 per kg, and at the same time, if we decide to convert, we are then going to also incur a cost of $4. So in essence, we are saying if we convert material Y conversion, the cost of converting material Y is going to be the opportunity cost lost, the $18 per kg, plus the ordinary conversion. Okay, the ordinary conversion cost per kg, which means the conversion cost is going to be $22 per kg. That's relevant costing, isn't it? Okay, let's think of another alternative. If we go back to the first paragraph, it currently has no material Z in inventory. The current purchase price of material Z is $20 per kg. This is expected to rise to $24 per kg in 1 month's time. So we can decide to wait until month end. Then we're going to buy this material at $24 per kg. Or we are going to buy the material today. Buy today. At how much? If you buy today, we are going to pay $20 per kg. $20 per kg. But we are told that if we buy today, then in 1 month's time, we would have lost 20% of the weight. So how much shall we buy today in order for us, okay? Because today it is costing $20 per kg. But in 1 month's time, if we buy the material today, in 1 month's time, it would have lost 20 kgs. So how much do we need? You can just pause the video for now and think. Okay, so this means that we need to then consider the 20% loss. So we are going to say we need $20. I mean, we need to buy or to pay for this material at $20 per kg divided by 0.8 or divided by 80%, so that we cash on for the 20% loss. So we are going to pay how much? We're going to pay $25. So what simply means is that we need to budget for $25 per kg if we really need 200 kgs at the end of the month. Because if we just buy the 200 kgs straight today at $20 per kg, it means that by the end of the month, we will be having less than 200 kgs. So in other words, we're going to buy more than 200 kgs, which means if you can do it the other way. Like for example, you can just stay at $20, then you say multiply by 200 over 0.8. Here, if we go this way, it means that we are saying 20 over 0.8 multiplied by 200 kgs. But you can as well get the same answer if you go this way. All right. So now, the idea I wanted only to bring about was the issue of pricing. Okay. The pricing aspect. So you then have to compare the prices. These are the options, the 3 options we have. Okay. Now we then have to ask ourselves, which of these 3 prices is going to be very competitive? Remember, we don't want to charge more to this particular customer. If we charge $25 per kg as a cost, it means that when we add our markup, it means that the contract is going to be very expensive to the customer. So obviously, we are not going to rely. This $25 is outside the competition. We are now left with 2 options. So this means that we need to convert the material. So the material Y, which cost us $22 per kg, and as well as to wait at 2 months end to buy the kgs at $24 per kg. So we're going to say the total cost in this case, total cost of the contract, it's a total relevant cost, is equal to $22 multiplied by 200 plus $24 multiplied by 200. Remember, we needed 400 kgs according to the question. It's 400 kgs required. Okay, and if you punch these figures in the calculator, let me check with mine. That's 9,200. That's the cost of this particular contract. Please replay this part of the video for you to get more insight. Okay, to get more insight into this particular logic or particular aspect of relevant costing. Okay, now let us do another past exam question to nail the point home. Okay, I guess by now you are now rejuvenated. You are now empowered to attempt a question. I mean, a typical exam question, and this one was actually a real examination question. It's a past examination question, and it has got its own casualties. And I hope you're not going to be a casualty in the upcoming Acca performance management examination. So please just flow with me as I will be sailing the tide, as I will be, turning the tide. So this one was a very long question initially, and it has been modified, and I just adopted as it is. I just adopted it as it is from the BPP revision text. So I've actually taken all the modifications as they are. All right, and I encourage you to use those revision texts as as part of your preparation for this rigorous Acca examination. Okay. The question is telephone co. All right. So the telephone co, T-co, is a company specialized in the provision of telephone systems for commercial clients. T-co has been approached by a potential customer. Always, always. The examiner would actually give you a hint that we are operating in a very dynamic business environment, which is very ambiguous, very complex, and very competitive. And for you to remain in business, you must price your goods and services very well. Just out of, just for your interest, Big Four companies, the Big Four audit firms, are actually finding it very challenging to remain competitive or to remain in business as they used to be in previous years, owing to their pricing systems. All right. So if they remain rigid, they are actually going to be decapacitated or to wind up. Okay. In many jurisdictions, they are closing shop because of high competition. You need to price your goods and services very, very well. And relevant costing principles are actually very ideal. They're very good for you to copy and paste if you want to remain competitive in this current business environment. All right, let's proceed. So there is a potential customer, which means if you price your goods very well, if you price your services very well, you're going to win this particular customer. So the customer is Pushco, and it wants to install a telephone system in a new offices it is opening. While the job is not particularly large one, Tico is hopeful of future business in terms of, in the form of replacement systems and support contracts for Pushco. So the examiner is hinting you that you can use these principles just to win customers for now, and then you then create a good playground for future revenue streams. Okay, so you can, price your initial services at the minimum, and then as relationships grow with this particular client, then recover your losses or recover your minimum revenues uh, from those long-term significant revenue streams from replacements, from um, support contracts, and so forth. TECO is therefore keen to quote a competitive price for the job. So here is the for the information we need to consider now as part of relevant costing. And in this particular case, there is no point of reading the requirement. Why? Because there are many requirements. There are 5 requirements. This is actually a typical section A question. So there are 5 questions related to this particular scenario. So it is actually advisable to just finish reading the whole paragraph, and then you'll be revisiting it as you'll be attending each question. So one of the company salesmen has already been to visit Pushco to give them a demonstration of the new system together with a complimentary lunch, the cost of which totaled $400. So do you think this cost is relevant? All right, now you might actually say, okay, fine, I just need to read 1 or 2 questions to understand what is actually going on. All right, so the first requirement can actually give you a hint of the topic. So what figure should be included in the relevant cost statement for engineer's costs? So relevant cost statement. This should be a statement prepared on relevant costing principles. Okay, so the engineer's cost, all right, is not actually this paragraph. So which means you need to read further. However, I was actually asking out of interest about this 400. The salesman has already visited the client to see the nature of so forth. So the costs which were incurred at that particular time are now considered past costs, but of which type? These are sunk costs. So you need to ignore them. Okay, so that cost is a sunk cost. Let's proceed. The installation is expected to take 1 week to complete and would require 3 engineers. Each of whom is paid a monthly salary of $4,000. So monthly salary, and we are talking of a quotation to a particular client. These guys are already on a payroll, and this 4,000, does it matter to this particular contract or this new contract? That amount or that salary is going to be paid whether the contract is one or not. So this is irrelevant. The 4,000 is irrelevant. The engineers have just had their annual renewable contract renewed with TICO. One of the 3 engineers has spare capacity. And remember, in the previous video on make or buy decisions, I indicated that when we have got spare capacity, it means that we are in a situation where we are able to get more jobs or to get new jobs or new contracts, we can actually take them because we've got the capacity. We still have got some extra capacity to meet them. Okay, so this particular engineer, one of the engineer has got spare capacity, which means he can do the job with no problem, and that's an advantage to the costing of the contract. Okay, so which means his costs are not going to lead to the increase of the contract price. All right. So one of the three engineers has spare capacity to complete the work, but the other two would have to be moved from contract X in order to complete this one. Contract X generates a contribution of $200 per engineer per week. There are no other engineers available to continue with contract X if these two engineers are taken off the job. It would mean that TICO would miss its contractual completion deadline on contract X by 1 week. As a result, TICO would have to pay a one-off penalty of $500. So if they take on the push-core contract, they are going to miss the deadline by 1 week, and by so doing, they're going to be punished for $500. They're going to be punished. So the amount of the punishment is $500, and that is a relevant cost. Okay, the 500 is relevant. That punishment is a relevant cost. They want to win this contract, but they are highly likely to miss the deadline, and they're going to be penalized. And the 500 is to be put as part of the cost of this contract to TICO. Okay, it is going to be put as part of the contract charge. Since there is no other work scheduled for their engineers in 1 week's time, it will not be a problem for them to complete contract X. Now, that statement, actually, I was also worried about this 200 because the contribution, which if the engineers were going to take on the push-core contract, it means that their contribution of $200 per engineer per week was going to be an opportunity cost. However, because these engineers have got no other work to do, it means that they've got a temporary spare capacity. Okay, they've got a temporal spare capacity, which means that their contribution elsewhere is not going to be an opportunity cost because they are just idle this week. So we can't say we are losing any contribution. So the only particular relevant cost in this regard is the $500. Okay, they have no work. Please understand this. They have no work. So the $500 should be the relevant cost. And let us see the answers. Yes. Now, what figure should be included in the relevant cost statement for telephone handsets? Now, telephone handsets, 120 telephone handsets would need to be supplied to Pushco. The current cost of these is $18.20 each, although TICO already has 8 handsets in stock. Okay, although TICO already has 8 handsets in inventory. These were bought at a price of $16.80 each. The handsets are the most popular model on the market and frequently requested by TICO's customers. So these items are frequently requested, which means they are required to be replaced. If we give them to Pushco, we need to replace them. All right. And how many handsets are required? Pushco require 120 handsets. So Even if we take the 80, okay, we need to replace them. At how much? At current price. Okay, and then we would also have to buy additional handsets. At how much? At current price. At current price. So which means we require how much? We require 120 handsets multiplied by the current price. And what is the current? The current cost is $18.20. So 120 multiplied by $18.20. How much is that? Let us use our calculators. Okay, so it gives us 2,184. This is the total relevant cost. Yes, the answer is B. Okay, so I'm sure you got the trick that if the items are to be replaced, then the current price the current cost of those items is going to be a relevant cost. Why? Because they are regularly required, they are frequently required, they need to be replaced because the customers are always going to ask for them. So the current price of those items and their quantities are going to be relevant. All right. Now, 3. What figure should be included in the relevant cost statement for the computerized control system? So let us read a paragraph on this. All right, I think that's the paragraph here, which is on top of the screen. Pushco would also need a computerized control system called Swipe 2. The current market price of Swipe 2 is 10,800. Although Tico has an older version of the system, Swipe 1, in inventory, which could be modified at a cost of 4,600. Okay. Tico paid 5,400 for Swipe 1 when it ordered it in error 2 months ago and there's no other use for it. Okay, so this is already sunk cost. The current market price of Swipe 1 is 5,450, although if Pushco tried to sell the one they have, it would be deemed to be used and therefore only worth 3,000. All right, so the market price does not is not relevant in this case because Tico does not want to replace. Tico does not want to replace. So 5,400 is irrelevant. Okay, so this one irrelevant, this one irrelevant. Okay, so we are left with all right, the current market price of Swipe 2 is 10,800. That's the current market price, and this particular system is required, but we need to then first consider other alternatives. Okay, the 10,800, yes, can be considered because we need this system, but what if we consider other? All right, like we can just do as we did in the first question we attempted. All right, so we have got the value for Swipe 2, which is how much? 10,800. But we also have Swipe 1 in inventory, which can be modified So modify swipe 1. Okay, if we modify swipe 1, we have to incur a cost of 4,600. Okay, but when we modify this, it means we're going to lose opportunity costs. We're going to lose 3,000. Why? Because we're told that although if Pushco tried to sell the one they have, it would be deemed to be used and therefore would only worth 3,000. So we're going to, if we modify, it means that amount of money, the 3,000, which would fetch if we just sell it, we're going to lose it. So the opportunity cost is 3,000. So which means this is, it gives a total of 7,600. So we have got two options, ladies and gentlemen: the swipe 2, which will cost 10,800, and this other, the modification route, which gives a total of 7,600. So which one do you think is the most competitive price? Obviously, this 7,600. That's the answer is A. So this is how you are going, ladies and gentlemen, if you want to pass. If you want to pass. if you really want to pass, this is how you're going to go about this uh, relevant costing scenarios. Okay, all right, so let's proceed. Which of the following statements about TCO's decision to quote for the contract is or are correct? Number 1, the opportunity cost is defined as the relevant cost of taking a business opportunity to install the telephone system for push call. Is that true? Is that correct? 2, the decision to install the telephone system should be taken on the basis of whether it improves profit or reduces costs for TCO. Is that correct? Is that what we have agreed so far? Okay, now this was the trickiest of the questions to this particular scenario. Okay, but even if the question was tricky, you were going to pass this question if you were going to stand by the principle. First of all, you were just required to know the definition of opportunity cost. And we have already discussed that an opportunity cost is the value or is the benefit forgone in vying for one alternative at the expense of another. So, by that definition, you can see that item number 1 is incorrect. The opportunity cost is defined as the relevant cost of taking a business opportunity to install a telephone system for push call. This one, although there is some, relevance in the way it is expressed, it does not define, it does not correctly define an opportunity cost. Then, so it means if one is wrong, it means that this is incorrect, this is incorrect. So you're left with B and C. Okay. Now, let us go for 2. The decision to install the telephone system should be taken on the basis of whether it improves profit or reduces costs for TCO. Is that what we have discussed so far? In as much as we want to value our services competitively, we also have to consider other factors which are non-financial. Point number 2 is actually telling us that we need to value business decisions or to base business decisions on financial points or financial basis only. That is not correct. That is not true. Okay? Sometimes we enter into a business arrangement or business contract on non-financial factors. For example, we might have decided to enter into the contract with the pushco on the basis of corporate social responsibility or on the basis of uh, being good, uh, I mean, environmental players. For example, if maybe we've seen that Pushco is an environmental friendly company and therefore needs to be supported. So it doesn't mean that we always have to value financial objectives all the time. Sometimes we consider social objectives. Okay, we can also consider political objectives. So there are a lot of things to be considered before a decision is taken. Okay, so in that regard, point number 2 again is not correct. So the answer is C. Lastly, what type of cost is the $400 detailed in point number 1? So we have already answered this point. Point number 1 is the cost, the $400 there is a sunk cost. So you can see that it's very easy to pass this examination. If you are just organized, you can pass these questions as easily as possible. So, ladies and gentlemen, I urge you to spread the word, tell your friends, your peers, your kids and kins that there is an Acca tutor in town, some guy who is ready to help you with your Acca studies wherever you are. You might be in Indonesia, in Australia, New Zealand, Yugoslavia, Russia, the Americas, Mexico, France, the UK, West Africa, East Africa, Tanzania, Kenya, Somalia, Egypt, or even in our next doors, Malawi, Botswana, South Africa. Guys, we love you. We want you to pass the Acca qualification as early as possible in your teens, just before 30. You just have to pass, just have to be chartered to be certified. So this is your opportunity, ladies and gentlemen. Let us start together. Let us pass the Acca qualification together. Until next time, ladies and gentlemen, may you continue to feel excited. I mean, very, very excited. Thank you, guys. I'm signing out.